If hard work can make anyone very wealthy, then people who clean HDB, the coffee shop, taking care of whatever, removing the utensils, they'll be very wealthy. Right now, when people buy things or invest in something, they listen to YouTubers. But I don't think it's that easy, because if it's that easy, our Minister of Finance also wants to listen to YouTubers. Unfortunately, right, accounting is the language of money. Whether you like it or not, you have to live with it.
What is it? Hello, good friends. Hello, people who are joining us on this podcast. Ladies and gentlemen, this is the Affinity Xchange. And right here, we do explore ideas with regards to finances. We really want to help people achieve these seemingly mythical idea of financial freedom. But is it really that mythical? I think, we look out in the world, we look out in Singapore. I live by quite near some private estates. And I think actually, these are some things that we can get to. But how do we get to? And today we do have two guests coming here to share with us more of their ideas. And in fact, today we are going to be talking a lot about investment. The first guest we have here today is Cayden Chang. And he is the founder of Value Investing Academy, the market leader in value investing education in Singapore, which provided education to more than 50,000 attendees across 11 cities in Asia. Now, he began investing at the young age of 25 and has been through 4 economic crisis and 6 bear markets across 29 years as an investor. And this allows him to fully appreciate what really works in investing in the long term. Now, for his professional side, right, he was trained in value investing in Columbia Business School in New York and Ivey Business School in Canada, and has graduated with 2 bachelor's degrees and a master's degree from the National University of Singapore. Now, he has also been featured in more than 30 occasions in various media and has established an endowment fund with the Singapore Management University called Cayden Chang Inspire Award to help financially challenged students. So this is our first guest for today. I give a virtual round of applause. And of course, ladies and gentlemen, from Affinity, right, we have Vincent. Now, he's an executive wealth manager with Infinity Financial Advisory under the branch of the Affinity branch, right? And he has a deep passion for investing and started dabbling in the stock market since 14. You can invest at 14.
When you can piggyback on your dad's account, then yes.
Okay, but I think that is something great to learn at a young age, right? He has been in the industry for close to a decade and is a big believer of upgrading himself. That is why he has the following accreditations under his belt: Certified Financial Planner, Chartered Financial Consultant, Certified High Net Worth Advisor, Precept Estate Planning Practitioner, and Certified Life Underwriter. And of course, he is also a member of the MDRT, that is the $1 Million Roundtable from 2021 to 2025. And this is Vincent, of course. But before we begin, right, I need these are bios that I have about you. But why not we take a few moments to share a bit with us a bit about yourself? How about we start with Cayden? Tell us a bit more about yourself.
I'm just like any typical Singaporean, and then I studied a typical traditional school system, graduated from NUS, worked predominantly 10 years as a corporate employee. And somewhere in August 2008, I decided to leave my job and then start my own business. But of course, schools don't really teach us how to start a business. So it's a lot of trial and error.
Trial and error, right.
And it was in mid-2010 that I started a Value Investing Academy.
Okay.
And the primary reason is because in 2001, 2002, when the dot-com bubble burst, actually I lost all my money, predominantly by wedding money. But it's nobody's fault. I think it's my own fault. So I think from that point onwards, I realized that we must be able to differentiate between having a degree, right, a traditional school system, and having some form of financial intelligence. Yeah,
financial intelligence.
Yeah, because most schools don't really teach us about money.
What do you mean by financial intelligence?
Let me give an example. Like a couple of months ago, there was an episode that was published on the papers about chocolate finance.
Chocolate, oh yes, yes.
So a lot of people put money in and then they cannot withdraw, so there's a lot of issues and so on.
Yes.
So now the question is, how do people get to know about chocolate finance? Then I realized that right now when people buy things or invest in something, they listen to YouTubers.
Yes.
Yeah. But I don't think it's that easy, because if it's that easy, our Minister of Finance also want to listen to YouTubers. Yeah, so
That's true.
Yeah, so I think it's important that regardless of whoever say what, right, I think we must have some form of financial intelligence to determine what's right and what's wrong. So I don't think those people who put their money in chocolate finance, I don't think they know what's happening.
Oh, yeah.
Yeah.
Really, I myself, one of the things, I am a very wary person.
Yeah.
One of the things that hold me back a lot from investing, especially in my earlier years, is that it feels like such a black box of things.
Yeah.
Yeah. And I think your goal of your business is to help people unlock this black box, help to see what's inside, understand.
Yeah.
I think there's Warren Buffett has a very famous line: if you don't understand something, don't invest in it.
Yeah, correct.
That's true.
Yeah.
Yep.
So if you look at Chocolate Finance website, actually they stated very clearly, but of course the font size is different. Some bigger, some smaller. Yeah, but I think it's not their fault. I think ultimately, since it's our money, we take 100% responsibility, right, to check through the fine print.
Yes. Yeah, what they call due diligence. Right.
But interestingly, when people buy laptop, they check a lot of things.
Oh, yes.
When people buy financial product, they all in, right? So quite dangerous.
Oh, yeah. I think there's also the appeal of, wow, I can make so much returns.
Yes.
Yeah. Cool. Thank you for that sharing also. And how about Vincent yourself? 10 years in the financial services industry. So far, has it been a fulfilling run?
Oh, definitely. Yeah. I would say probably because of my background where I was kind of fortunate, where I had my dad to lead me into this investing track. At the same time, probably because he was more of a trader back then. You know, those kind of old uncle mindset. Hey, today $1 drop to 50 cents. Wow, cheap, buy. Then later after that 50 cents now rebound to $1. Wow, I can sell already. So I was at that kind of mindset where, you know, back in the earlier days, there was teletext.
Right. Yes.
Yeah.
I remember.
Correct. So back in the earlier days, sort of like reveal my age already. Teletext days, I will take a book, then I'll write down all the numbers, and then I'll think that, hey, you know, wow, today is cheaper, then probably should consider ask my dad to buy in some and things like that. Yeah. So that was how I got started. But along the way, I realized that, why is it that this formula is no longer working when suddenly this company, if I recall correctly, is called Lao Ing. Yeah, in English translation, is Old Eagle.
Old Eagle.
So probably it has getting older, can no longer fly. Then as a result, it just went bankrupt. So that was where it triggered me. Is there a possibility whereby I'm doing something that I'm not aware of? As a result, I actually started going for more courses, learning more about it, reading more books, and I realized that, you know, because of this episode, I become more wary of the investments when I advise my clients, because my risk appetite could be very different from yours or probably different from Cayden. So as a result, as they always say, we always need to do our due diligence, doing the fact find and such before we even recommend the products. So that's my modus operandi at this point.
Modus operandi. That's the mode of operation in Latin for those of us who don't understand. Really, I think one major difference between what you are doing back then versus what you're doing right now, I think a lot of people will say that is trading versus investing.
That's right.
And that is a very huge difference, right?
That's right.
Yeah. So right over here, since we're focusing a lot on investing. We're not talking about when stocks go down, we buy. But of course, in investments, there are certain strategies that take advantage of that. But let's go into investing. And I would like to ask Cayden, what are some of the core principles that you believe every investor should understand before they enter the market?
I think there are two broad categories. One category is the qualitative part. For example, if you want to buy anything, right, including the microphone, laptop, iPad or whatever, usually you check through how does it work, does it suit our needs and so on. So for investing specific, let's say you want to invest in a company, any company that think of, there are a couple of questions we need to answer. For example, how does the company make money? What's the business model? So the first question you need to ask is what? Next one is where do they operate? Now their HQ may be in Singapore, but they may operate elsewhere. And then understanding where is quite important because there's some business that simply cannot expand. For example, let's say Xchange, right? Predominantly the market is here. I think unlikely they can go anywhere outside Singapore. I think it's going to be quite tough. Which is why recently the growth of Xchange is quite stagnant. So where, right? The other one is types of company. Some seniors, they may go for so-called the blue chip stock. They are just big companies, but they're very slow growth.
Low risk.
Tend to be low risk, better dividend paying. And some may be fast growth. Fast growth usually no dividend, little dividend. So types of company. And the last one, which is quite important, right, is when we buy into a business, we're buying the company's future. It's like when we say yes to a marriage, we are making an assumption that in the future will be bright. So you cannot make assumption in the future when you know nothing about the business.
True.
So this is a qualitative part. Then the quantitative part is, unfortunately, right, accounting is the language of money.
Yes.
You
it
can't.
is.
Whether you like it or not, you have to live with it. So for example, if you do not understand financial statements, some of the jargons that are being used, they should not buy any stocks. But people buy stocks because they hear someone say it.
Yeah.
Yeah, so it's quite dangerous.
It is,
So,
it is.
they need to thoroughly understand this tool before they buy individual stocks.
I believe the key thing is that people need to do their homework. Is that correct?
Provided they have the knowledge to do the homework, because sometimes they want to do it's
Really,
like
really?
yeah, it's like they say, okay, this is my car, I'm going to repair the car, but I do not have the knowledge to repair the car. So so they have the will, right, but they do not have the capability.
Right.
Yes.
Yeah.
Which is why a lot of times when they're repairing a car, they send it to a workshop, send it to a mechanic.
Yeah,
And
exactly.
then when they're looking into investments, right, because there's a lot of things going there. And I go in, I myself, I'm like just, my eyes are darting everywhere. I have no idea what to look at.
Yes.
And I think sometimes it does help, like where we have a trusted mechanic, where you have a trusted workshop,
correct.
you have a trusted financial advisor.
yes.
Is it correct? And trusted financial advisor might be who? It might be Vincent. Will it be Vincent? But, yeah, so because since we talk about financial advisors, right, from the perspective, what are some other areas that a investor should look out as a beginner before they invest?
Okay, probably I can share a case study that I came across. So I have this friend, he's about to get his property in the next 3 years. So I've been helping him to invest for quite some time, and he realized that, wow, the returns are actually much better than what he's receiving from his CPF OA. So he was asking me, hey Vincent, if that's the case, should I go all in for my CPF since the returns are much better than the OA? So of course, based on taking a step back, you take a look right now, it doesn't quite make sense, right? Because in the next 3 years, you need it for your property down payment. And this is more of like a major milestone for a person, and it's a big ticket item, more importantly, not like any small ticket item. So given that situation, I told him, why not you just keep your OA? Because at the end of the day, you need it for your property. I don't want later your wife come and scold me, hey Vincent, how come you lose our CPF money for down payment? So I don't want to be caught in that situation. So I'm glad that my friend actually listened to my advice. And true enough, 3 years later, it was 2022. And if you take a look across the market, be it whether you are investing in the equities or in the bond space, everything was down. So he sort of escaped that drawdown or that fluctuations. And as a result, he managed to have the sufficient funds for the down payment. So in my opinion, I think before anyone even start investing, probably they should set aside their emergency cash of about 6 months to 1 year.
6 months to 1 year. Wait, is that of your expenses or of your income?
Wow, that's a very good question. So it depends on how kiasu you are. So if you're kiasu, you can put aside 1 year, primarily because sometimes, especially when one gets older, wanting to find back that kind of high income jobs may be very difficult.
Yes.
Yeah. So as a result, maybe if you want to be more kiasu, you can set aside, or probably more conservative, you can set aside that 6 months to 1 year time frame of your income. If you find that, I don't need to set aside so much, probably 6 months to 1 year of expenses will be good enough as well.
Right. I think one thing that because I also came from the insurance background is that if we do have our financial protections in place, it's much easier to set aside the expenses as opposed to the income.
Definitely.
Is that correct?
Correct. Yeah. Because we do not want to be caught in a situation where we need to sell the investments in order to purchase our big ticket item. But of course, the end goal of investments for most of us is to grow our pot so that we have sufficient for our retirement. I believe that's what most of us are actually looking at.
I think another thing that I gained from what you have shared is about being aware of our timeline.
Yes, that's right.
Because when we make plans, we are thinking about what's going to come next. It's not just entirely about retirement. There are so many milestones along the way.
Definitely.
A purchase of a house, whether we have a kid coming along the way.
Yes.
And all these things require money, and being able to look out for that, like you saw for your friend. In 2-3 years, he's going to need the CPF money to put down for his property.
Down payment. Yep.
Yeah. And because of that, you advised him to be a bit more conservative with that. Right, so I think that's good on you. I think that's a wonderful case study that we can look into. But right over here, so as we are going into investments, I think one thing that is an overarching theme nowadays, there's a lot of things coming out in the market, and especially because as we become a society with more disposable income, right? We have this money to set aside, this money to park inside investments, and then we start to receive a lot of advertisements. Like the first time I saw chocolate finance was on a bus. Vroom. And chocolate finance with an influencer's face on it. I know it's an influencer. I have no idea who that person is. But I see it everywhere, and that probably made me think, what is this chocolate finance? And I see the high interest with zero lock-in, and that's a very powerful appeal. So in addition to that, there are other things such as AI, robo-investors, all these. So let's go into this a bit. Now, what should an investor consider? Whether to do it yourself, a robot investor, or getting a trusted advisor for their investments. What are the differences between these two? Let's not hit too much on the advisor because Vincent is here. I'm just kidding. No, but I'm very curious to hear your take, Cayden.
I think in order for that person to decide on whether it's a robo-advisor or whatever that's available in the market, is all correlated to how much he or she knows. There are two ends of the spectrum. If that person knows nothing, let's say zero, you can't possibly do it yourself. Yeah. If you know 10, then you don't really need any one of this. Yeah, so it all depends on every skill, right? Yeah, so to me, it's either 0 or 10 because if it's 5, right, it's as good as 0. Yeah, because the most dangerous thing to invest is when you know little or you know partial.
Right.
It's quite dangerous. Yeah. So for example, right? Well, this one I don't know whether will I get slaughtered. but anyway, but this one is in the social media. So there is this very cute guy. His name is called Stephen Lim Koko.
Oh.
Yeah, I find him really cute.
Very familiar.
Yeah, very familiar. but anyway, he published on the investment on Facebook.
SingPost.
Yeah, SingPost.
Oh, the SingPost.
Yeah, so he sold HDB 300K all in the SingPost.
Yes.
Yeah, and then of course I listened to their podcast as well. Eventually he cut loss at 120, and fortunately he did. So he's left with 180 because if he didn't cut loss, he may lose everything. So lucky he cut loss, he still got 180, right? So when I was watching the podcast, I think his intention is good. At least from my perspective, I don't think he know enough to all in right into one individual company. Yeah, so this on a scale of 0 to 10, he may argue that it's 2 or 3 or 5.
Yep.
But 2 or 3 or 5 is as good as 0. So I think it's best that he don't do it.
Right.
Yeah.
Okay.
It's just an example. Nothing against Stephen Lim Koko.
Of course, I think he's a very entertaining personality. It's very fascinating. Yeah, but why do you think a person goes all in like that? What could be the reasons?
I'm not sure. You know, I think this is like how Isaac Newton in the early days lose money. So when it comes to investing, interestingly, people use the right brain more than the left brain. Yeah, it's like an emotional decision.
Yeah.
Easier said than done, right? Right now
Yes,
in the podcast,
really.
easier said than done. I think at the end of the day, our decision-making process when it comes to investment, right, it has to rely on the numbers. The numbers has to tell us what to do. And we are right because our numbers are correct. Not because somebody, you influencer or whatever, are telling whether we are right or wrong. Yeah, so investment has to be a very logical process, and that includes purchase of any financial products and so on. Has to be a very logical. But again, it's easier said than done.
Yeah, definitely. Because I think also from people in sales, people make decisions with emotions.
Yes.
Yeah.
Yep.
They justify it with the facts and logics. Yeah.
Just look at the recent Terry war. Just because Trump said something, the bucket like dropped, S&P 500 dropped about 17%.
Yes,
He has
goodness.
no logic one.
Yes.
Yeah.
Yeah, yes.
And then it bounced back up, and who knows where it's going right now.
Yeah. At least from my perspective, there will always be people like that. These people will form majority, and because these people form majority of so-called investors, right? It's a very good opportunity for me because when they sell, I buy. When I sell, they buy.
Right. Yeah. We can think that what people should do, but at the end of the day, everyone has their own agency.
Yeah.
They make their own decisions. What we can do is that we see this is the market, this is the environment, and then we see how we can best, benefit from it, how we can best make our money from it. On your side, Vincent, what would you advise? I mean, clearly you will say, please go for an advisor.
Probably I'll give a more politically right answer.
Okay.
Yeah, just joking. Yeah, but just to build on a little bit more on Cayden's point earlier, I totally agree with Cayden on that part whereby if let's say today we are 5, it is as good as 0. Because I do come across friends where they think that they know enough of a certain company and as a result, they go all in. And what I mean by all in is literally they only have 2 companies in their entire portfolio. Then I asked my friend, imagine, hey, today, if let's say both these companies go down, your entire portfolio and net worth also go down together. And it's not like this kind of blue chip stocks. They are really very volatile. And yeah, one is an electric vehicle company from the US. I think most of us may know. Starts with T. Yeah.
The turtle.
Yeah. And then another one is a defense company also in the US. Also start with P. Yeah. So you can imagine both of these companies that are very volatile. I don't know much about the P company, and I believe in investing, the interesting part is all of us can have different views about the companies and the market. So it's perfectly okay to have differing views. But I think like what Cayden mentioned earlier, if you think that you know enough and as a result you go all in, and especially in this particular friend's case, just 2 companies, I asked him, hey, are you ready to go big or go home? Yeah, because literally if both companies for whatever reason has some issues, then his entire career, or should I say his savings, is going to be wiped out. Yeah, and can be quite scary.
Yeah.
Of course, I do not hope the worst for him, but I did share with him. But as you know, sometimes, like we mentioned earlier about the emotions, they could be very blindsided, and probably based on the profits or the returns that they have seen thus far, they're quite happy with it.
Right.
Yeah, so I think that part there comes back down to a book that I've come across by Morgan Housel on behavioral finance. So it's the part whereby sometimes we could be having confirmational bias or confidence bias in the sense that we have seen the results, we think that this will continue, and as a result, we'll continue to double down on it. Yeah, so I think that part there is where probably having soundboards or, looking at podcasts like this will actually help to give a different light, show a different point of view, and from there probably intrigue and invoke more thoughts and emotions that, maybe I should reflect and look at this portfolio again.
Ultimately, these media like podcasts or all these, I think we have to understand that it's all opinions, it's all perspectives, things for us to consider, not saying that, okay, this podcast say we buy things and let's go all in.
That's very dangerous.
That's right, they're definitely very dangerous because ultimately we also have to assess the credibility of our sources, right?
Yep.
I want to go into the conclusion on this one. So based on these things that we have shared, what do you think an advisor should consider between doing it themselves, maybe like buying on Tiger or Mumu, all these? I've been getting so much ads, man.
Can just buy all your money with me. Just joking.
Whether DIY, a robo, or an advisor. I mean, it's understandable that you would have your perks for an advisor, but what are they?
Yeah, probably putting aside the career or the remunerations that I may get from here, but I'm just seeing it from a very neutral point of view. I see it this way. Probably you can think of it like buying your clothings. So there are different ways of buying clothing, right? You can either go online, you can shop for it, and then that's where you get the cheapest price. But of course, in order for you to ensure the quality of it, you go through all the different reviews, the different vendors. So you realize that you're spending a lot of time and effort on doing it, but at the same time, you get the cheapest price for the clothing that you get. The other kind is where probably like myself, I like to go to Uniqlo to get my clothing. That's where you notice that there's a predetermined size. Certain areas maybe can fit well, certain areas may not be, or some lines of clothing, like especially for jeans, it doesn't quite fit well for me. Yeah, so that's where I realized there are certain limitations to it. And then of course you have the best, which is you're going to pay more because you're going to engage a tailor, for example. So I see it this way whereby there are pros and cons to each of these options. I'm not saying one is better than the other, but it depends on your situation at that point. Are you willing to spend the time, the effort? Then probably it'll be best to go for courses like Cayden's one to learn more about it before you actually DIY. Because even when you go to online sources, right, sometimes you purchase, you think that with all these good reviews, it's good enough already. Then by the time you purchase, you realize that it doesn't quite fit me. So that's the part whereby it's very important to have the knowledge to do your homework, due diligence, and you have the DIY is also good. Just that probably they have certain predetermined kind of portfolios that are already in place, and it may or may not fit you. Yeah, so it depends on individual, no right or wrong. It's just that you have to see what works best for you.
Okay. No. So how about on this part? I think, Cayden, I want to come back to you because there's this thing that we talk about robo investors, especially with the advent of AI, right? ChatGPT is such a huge thing, but I myself, I really can't get into ChatGPT because all the answers they give me, I always find some problems with it. But then there are a lot of people who, ChatGPT will give me all the answers. It's like worship. So how does that apply when it comes to investing? What's your thoughts on this?
I think if you use ChatGPT to do some research, I don't think there is an issue, but we just need to remind ourselves that we do not know the trustworthiness of the information. Yesterday, I was searching for something. I think right now it's getting better. At least they put the source. But I realized that the source was dated like way back, like 2018. Yeah, they didn't give really the latest one. Yeah, so to me, I think it's still useful, but we need to be mentally prepared when we are using such tools. It's not perfect. And again, the responsibility lies within us. We cannot buy and then say, hey, because ChatGPT tell me to do so. Right. Yeah, but it definitely helps. Right now, just in case the audience don't know, you can actually upload an annual report, right? And then you ask question. How does the company make money? And then ask for detail depending on the prompt, the percentage. And they already sell the percentage. So I think in that sense, it really helps laymen to DIY. Yeah.
But you have to know the correct questions to ask, what to look out for.
Yeah, correct.
If they don't know the questions,
I think I'll probably just upload the annual report and ask, should I buy this company? Yes or no?
Then there's a very high chance they'll give you a politically right answer. So.
And beyond ChatGPT, right, the whole concept of robo-investors, I think there are a few out in Singapore right now.
Yeah.
So robo-investors is basically, I picture it like a financial advisor, but this financial advisor is ones and zeros. It's all digital. Yeah. So do you think these have a bright future in investing?
To me, at least based on the amount of money that they raise, it's definitely yes. Because out of the 3 robo-advisors company that are available in Singapore, only one make money. The other one is not making money.
Oh.
Yeah, but the interesting thing is out of the 2 companies that do make money, they have I can't remember what was the exact asset under management, but I was quite surprised. Yeah, so it shows that there are a lot of people with a lot of money. They do not mind passing the money to some companies where they have not made money yet. And then yet they promise them they're going to make money. But again, back to what Vincent said, it's a matter of choice. Yeah.
All right. How about Vincent? What do you think about AI taking over your job?
Oh, I sort of foresee that. I was like a quote that there will be a doomsday scenario, but let's leave it for another time and focus on the investing one. I see it this way. AI tools at the end of the day is more to aid us as a complementary rather than as the main driver. So like what Cayden mentioned earlier, if you don't have the knowledge, you don't know what to ask, it's going to be very difficult. There's a very high chance that I just throw the annual report and I'll just ask ChatGPT, hey, can I buy this stock? Then ChatGPT will definitely give you the pros and cons. Then probably if I'm biased, I really like this company, I'll think that, hey, based on what ChatGPT said, it makes sense. And then I buy in, then what happens if it loses money? Am I going to blame ChatGPT? Yeah, I think it's going to be quite difficult, right? Yeah. So that part there is where I find that probably you need to have some knowledge, like go for courses, read more books, learn more about investing first before you do this kind of investing tools. But what is good is that if you already know what you're doing, then these tools can actually help to expedite your entire research process rather than, going through every page line by line in terms of what are the finances. Or probably if let's say I'm a beginner, I'm not exactly sure what this jargon means. I can ask ChatGPT, hey, can you explain to me like I'm a 5-year-old? Yeah, then they are able to help that. So that will help in our understanding process. So it becomes more of helping you to understand what all some of these terms or the balance sheets or all the financial jargons make sense to you before you make a decision whether should you commit to it. Yeah, so that is where I find AI will be able to help complement us in the investing journey rather than take over us. Having the thought of sitting in a humanless vehicle is kind of scary for me. Yeah, of course, you can say that right now, most of our trains in Singapore are actually driverless, right? But if you realize there's always someone behind the scene that can control, at the press of a button, they can stop the train or things like that. But when it comes down to vehicle, it may not be that way. Yeah,
Right.
Likewise, for investing, how do you know when to press the button to click the button to buy or sell? Is this a good price? I think that is the more important question. You can have different perspective of the company. The valuations for all of us for individual company could be very different. But if we do not even have a baseline of what is our valuation of this company and we just buy in blindly, then it's going to be very dangerous.
Okay. Oh, so AI would become more of an assistant.
Yeah.
Yes.
Yeah. But of course, the effectiveness will be based on how much we know about
Yeah.
things and how we can get it to work for us, right?
Yep.
So speaking about knowledge, right? I think there are so many things that go into investing. One of the major things is the things happening around the world, current affairs. And in fact, nowadays, something that is looming over us all as a topic of 2 major wars going on in the world right now. So right over here, one of the things that we want to talk about is the market volatility. So how would you advise investors whether to stay the course during market volatility, especially with like macro uncertainty events like the Trump tariffs or the Israel-Gaza war, etc.? How will these affect? Because these will definitely get people to feel what we in Singapore say kanchiong, anxious. And these are very dangerous things when it comes to investing. So maybe we start with Vincent.
On my end, I did come across an article talking about this legendary investor, Peter Lynch, which I think Cayden and maybe some of the audience may be aware. He manages the Fidelity Magellan Fund from 1977 to 1990, right? He actually had a compounded annual return of 29% per year. Wow, that's fantastic, right?
Yeah.
But what is interesting is based on Fidelity Investment, the firm, the average investor actually lost money during his tenure. Isn't that a bit surprising?
How?
How exactly? So what was noted was that investors tend to have a knee-jerk reaction, like what Cayden mentioned earlier. So whenever they see like market goes up or comes down, they'll actually react accordingly. So if it comes down like during this period, wow, suddenly the S&P 500, which is like the US stock market index, came down significantly, they have a tendency to sell because they're worried that if they don't sell now, if it goes lower, then they may lose even more. And likewise, the reverse is also true. I see some of my friends during this period of time, gold has been hitting record high. Wow, they all queue up at UOB to buy gold.
Wait, queue up.
Yes,
At this
literally.
day and age, queue up.
So that's where I'm scratching my head. Then I was like, aren't you like buying at the high at this point in time where it's breaking new high? Yeah. So I think that's where it becomes very important to understand what is happening on in the market and how do you even manage your emotions during this period of time. So across the years, as I'm talking to different investors and clients, I start to realize that, it's their natural tendency. It's counterintuitive in a way. If today, what is your favorite, probably next item that you're going to buy, Jackie?
You mean
Any item like laptop
physical
or
item?
Yeah, physical item.
Oh, I have no material ones, man.
Let's say a new iPad, for example.
I'll probably get a new phone when when I need it. Yeah.
All right, sure. Let's say maybe you are going for the next iPhone, for example.
Yep.
Okay. So if let's say today the next iPhone, the retail price is at 2,000. You see it selling at 1,008. You
Yes.
find that it's a discount, and would you buy it?
Well, I will still think about it, man.
Oh, wow. Really cautious buyer.
I have a very long decision runway.
Okay.
That's why I always join things when it's too late.
I see.
Yeah.
Okay. So I think most people would think that, if I can secure it at 1,008 instead of 2,000, which is the retail price, is a good bargain and I'll buy.
Right.
But imagine if, let's say today, this is an Apple stock selling at $200. Right now, it's at 180. Most people would think that, I'm losing money already.
Alright.
I might as well wait for it to hit new high to buy. So that's where I find that it's counterintuitive. It's a little bit like insurance concept. I buy insurance not to claim, but as a form of safety net. Yeah, counterintuitive. So that's the part whereby I find that investing, if you can see it that way, whereby when you see red, it's actually a buying opportunity for us as investors, then that would be fantastic.
Yeah, really. Sometimes I go online and I also have friends, especially when the Trump tariffs came in, right? So I see my friends posting, wow, it's time for shopping.
Yes.
Yeah.
That's right.
So how about Cayden? What are your thoughts on these sort of macro events and staying the course or whether to let go?
Usually I don't care. Usually I don't care. That's number one. But in order for us to take advantage of it, we need to understand two basic philosophies, which is very important. So philosophies are like foundation of building, right? You cannot build a building without foundation. So the first philosophy we need to look at is we must understand that volatility is not equals to risk. This is the first fundamental. Second one, right, is price, right, may not necessarily equals to value. So let's look at the first one. So when if you go and Google volatility, what does it mean? In simple terms, it's just the probability, right, that there's going to be a price swing. High volatility, that means the price will swing very high or swing very low. Yeah. So this deviation of this price swing, does it equate to risk? Yeah, actually it's not necessary. So if I write on what Vincent has just said, if the price swing high, that means if you want to buy the stock right now, you pay at a high price. If the price swing low, yeah, you want to buy at the low price. So of course, if you map it across to buying any things that you want, right? Obviously you want to buy when the price is low. But when it comes to stock market, people somehow their mind is reversed. Or low is bad, high is good. Yeah, but in order for us to sell at high price, we have to buy at the low price, right?
Yeah.
How can you possibly buy at a high price and then try to sell at the low price?
Yeah.
Which is why most people buy stock, they lose money. Because they have the intent to buy low, sell high, but they end up buying high, selling low. The fact that just because Donald Trump said something or tweet something, the price drop, it simply means that people are selling. Yeah, so it doesn't make sense. Yeah, but volatility is really good for value investors to take advantage of it. Yeah, so that's the first philosophy. Now, the second philosophy is price not necessarily equals to value. Now, stocks is unsafe in the short term, but safe in the long run. Let me give you an example, right? There were 3 Nobel Prize winning economists. I think one is called Eugene Fama, the other one is Robert Shiller, and the other one is called La something. But anyway, they won Nobel Prize because they proved 2 things. Number one, share price in the short term can never be predicted correctly, consistently. Yeah, so, and then if you relate back to the people who are the richest people in Forbes list, none of them is the market timer. Yeah. Then the next one is, but they conclude that in the long term, about 3 to 4 years, price usually correlates with the value of the company, the profit of the company. And the best part is these 2 lines do not happen simultaneously. They happen sequentially. So what does it mean? It simply means that when a profit goes up, subsequently, right, the price will go up. But in the short term, it's unpredictable. I can give a very specific example. So during the COVID time, right, we buy things e-commerce, the Shopee. Shopee is actually one of the service provided by C Limited. Yeah. So actually during the period year 2020, 21, I think also year 22, the company is actually losing more and more money. The profit is down, it becomes more and more negative. But the price is reversed. Yeah. So you realize in this short term, the price doesn't equal to the value. Yeah. So it doesn't make sense for a person to pay more and more for a company that's losing more and more. Yeah. So what happened is common sense has to prevail. That includes the current tariff war. So eventually, I don't know who bought the top, but good luck to him. Subsequently, he came to a realization that I'm overpaying. But it's too late because price usually fall very quickly. So eventually, I think over a span of 4 to 5 years, eventually these two lines converge. Yeah. So we must understand these two concepts. If we mess up these two, we shouldn't be buying individual stocks. Yeah.
I love your analogies. The way you put analogies into pictures, like those being the foundations of the house, is very important, especially for our viewers if they are unfamiliar with investing. It helps us get a much easier grasp as we compare to things that we really relate to. Now, the second thing I think we probably should have went into earlier, what is value investing? I've heard a few definitions because I've seen stuff around, but what is your definition of value investing?
Actually, it's quite easy. It's to buy something good at a cheap price.
Something good at a cheap price.
People who are slightly more senior, if they are hawking at Teochew, sometimes you hear people say, you want to buy something IP and IT. But if it's good, how can it be cheap? There is, which is why Singaporeans like to go JB to makan.
Yes.
Or pump petrol or buy cigarette. Of course there is.
But to put things into perspective, in things in JB to the Malaysians, they're not as cheap.
Expensive.
So
it's to buy a good business at a cheap price.
Good business. It sounds like such a simple concept, right?
Yeah.
But I mean, it is a simple concept. But then all the legwork that goes into determining what is good and what is cheap.
That one requires financial education.
Just like you mentioned in the Shopee example earlier. Yeah. It looks great because wow, stock prices are soaring. Yeah, it looks good, but is it good?
Yeah.
Am I correct to say that?
Yeah. Most people look at price. But they do not know how much the stock is worth. I'm quite sure people who are listening to the podcast, if they ask themselves the question, how much worth is the stock that they're holding? I don't think many people know. So if you do not know how much the stock is worth, right, then you will never know when to sell.
Earlier, Vincent was talking about the iPhone, right? We can see that iPhone. So we roughly know the value of an iPhone. Let's say the market rate is 2,000. But let's say we don't know the market rate of the iPhone. We don't know what that intrinsic value is. But then we look at 1,008. Is it expensive? Or 2,004? Is it a good price? Yeah. So, but in order to have that information, when you have the information about what that value of the iPhone is, it becomes a lot easier to make that decision. Could that be one of the fundamentals of value investing?
That's one of the many things people should know. Let me give you an example. Like you say, people rush to buy gold.
Yes.
So now the question is, how much is 1 kg of gold is worth? I don't think anyone knows.
Yeah.
Yeah. So during this whole process, who is making money, the seller or the buyer? You realize are the sellers.
Yes.
And if you travel back in time, way back during the COVID, right, when cryptos are the in thing. Yeah, but where are the cryptos right now? Yeah. Then the next one is, for example, after cryptos went to the winter stage, right? The next one is NFTs, non-fungible tokens. Can you imagine someone pay $500,000 for a soft copy of a picture that look like an ape? Yeah. So now the question is, how much is it worth today? It's practically worthless.
Yes.
Yeah. So the moment somebody buys something and that something produce nothing, you will never know how much it's worth. And that is a greater fool theory. You buy at $100, then you do a appraise. Hopefully somebody pay 120, then you make that 20.
Yeah.
Yeah. But when will that happen? It's happening right now to the goal.
You say greater fool theory. That means this person is a bigger fool than I am.
The person who buy the gold is waiting for a greater fool.
Oh, okay. I see.
This gold thing, it will reach one point of time that it has to stop.
Yes. So is it right to say it's like a bubble?
Bubble, I think depending on what's the definition of the bubble, I think for the .com, that one is really a bubble. Gold, I'm not very sure. But somebody eventually will have to pay at the highest price. Again, common sense will prevail, kick in, overpay, then they want to sell. That's too late. So during this whole journey, right, the one that makes money, guaranteed, are the sellers.
Yeah.
Seller of the gold.
Yeah, just to check, Cayden, a different kind of perspective. What do you think of, because gold has been around in the investing, what they call it, realm for quite a while, and they always quote unquote like to say that, gold is your safe haven in the event of such turmoil and such. Yeah. So given this situation, do you find that, could it be a potential asset class that investors could consider, but probably not at this price? Or you find that, in your perspective, gold is totally not a worthwhile investment?
No, I don't think I can say that it's not a worthwhile investment because back to just now what you said, the choices that we make is all limited by what we know and what we don't know.
True.
Yeah. So for example, if my mom is still around, I cannot convince her to buy S&P 500. There is no way. But even with almost zero knowledge, she will say go. So can I say she's wrong? I don't think so, because if you look at the historical data, right, in the long term, actually gold price it creep up slowly.
Yes.
Yeah, but the highest performing asset class is actually equities. Yeah, but because the choices that we make is all limited by what we know and what we don't know. So through the lens of my mom, right, if she's still around, she will still choose gold, and I cannot say she's wrong. Yeah, because she just don't know what she don't know.
It all begins with knowledge, right?
Yeah, correct.
All begins with knowledge.
That's true. More knowledge, more choices.
And this is something that I myself, I would say I'm a very lazy investor. There's so many things going on. There's so many types of instruments and all. I myself, I just like to see what is something that is likely to be reliable. And my go-to is actually the S&P 500. Yeah, just put my money there and I don't look at it. As my thought is in the 10 to 15 year runway, right, it's going to read me at least 8 on a very conservative side, 12 on a higher end. So that's like the extra pocket. But that is investing, long-term things. So when we talk about long-term things, right, what do you think are some of the trends that we can anticipate in the investing landscape for the next 5 to 10 years?
I'm not very sure about other market, China market, whatever, but I'm always long US economy. Yeah, at least based on the past 100 years. Yeah, so if I look at if I state some historical facts, for example, if you look at the S&P 500 index, right, for the past 94 years of market history, there's only one direction, and that one direction is up, which is why I said that stocks in the short term is dangerous, in the long term is safe. Yeah, so that's one fact. Second historical fact, you realize that in this whatever 50 years, 100 years, that there's always the bull market and there's always a bear market. Yeah. So, but the interesting thing is no bear market stays forever. After every bear is always followed by a bull. So a second historical fact. And the third one, if you look at the past 94 years of a S&P 500, right, about 21.6% is bear market, which means about maybe 78-79% are bull market. So what does it mean? It simply means that the time that we stay in the market, right, is more important than trying to time. It's because if you stay within the 100%, only about 20+% is bear and the remaining 80% is bull. So as long as we stay within this business cycle, right, going through thick and thin, we make money most of the time. Yeah, so we need to know this. Yeah, once we know this, then it's a matter of just dollar cost average, low cost S&P 500 index fund. Don't go and think about it. Since 1965, right, we've dividend reinvested, the annualized return is 10.4. So I use that as a benchmark. So if right now I already know, all the audience already know 10.4, why would they buy something that pays 3? Yeah, it doesn't make sense. So I use that as a benchmark. Anything that's lower than this, usually I have no interest.
Right.
Yeah.
But that's of course with a long run.
But short term, maybe you just select something else.
I've heard about this analogy of the yo-yo on an escalator. So you look at the yo-yo itself, is going up and down, but the big picture is that it's on an escalator, even though the ups and downs will still be going upwards.
Yeah.
Right. How about Vincent on your side? What do you think you can anticipate in the next 5 to 10 years?
China. No, just joking.
But it really is a lot of chaos going on in the world right now.
Exactly. Yeah. So to me, rather than talking about where to invest or which geographical location, probably a better way to look at it is at your individual circumstances and situation at this point in time. I'll quote an example. In the financial planning, we have this rule, the classic rule, what we call the 100 minus age. So what do I mean by that? So let's say, for example, I'm 30 years old. So right now, 100 minus 30 means 70, right? It means 70% of my allocation should be in equities. It could be S&P 500, or you could be more aggressive. You want to put in certain sector funds or probably geographic funds, by all means. That one, we can talk about it later. But the other remaining 30% should be in bonds. Because from my perspective, talking to different clients along the way, only a minute group of people would really know what is their risk appetite. And I think that is really very important. Because if you do not know thyself, it's very difficult for you to invest and win the battle of investing, right? Because as we are aware, investing is very volatile. So I've come across clients whereby they tell me, hey Vincent, don't worry, I can take on volatility one. give me the most aggressive fund, the best return that you can get. So as you know, what the outcome will be. The moment then later started ringing me up. Hey Vincent, how come this thing dropped 5%? I was like, you told me you can tahan 20, 30, 40%. Then now 5% only. Yeah, I'm expecting an update from you. Then as you know, this kind of clients don't really exactly gel well. So not that it's the client's fault or even my fault, because at the start,
it's human nature.
Exactly. Yeah. And especially if you're new to investing, my advice usually would be you just put a little bit of your money to test it out first to see if it's suitable for you. So if let's say maybe your budget is 100,000, instead of the full 100,000 going in, maybe you can start off with 5 or 10,000, get your feet wet, dabble in it, and roughly know what is the kind of risk appetite that you can. Because you may be investing like what we saw earlier on the Peter Lynch fund, having fantastic returns. But if the investor himself or herself can't tolerate the volatility, and as what Cayden mentioned, it doesn't mean risk. Yeah. So we always hear this saying, a high risk, high return. That is true for most cases. But if you know what you're doing, you can actually reduce your risk and still garner that kind of return. So the important part is you want to have a mix of equities and bonds. Going back to the earlier example, if I'm 30 years old, 70% in equities, 30% in bonds, that will give me a good volatility as a start. Along the way, as I'm getting more and more comfortable, I can always adjust the percentages accordingly. And then if let's say maybe I'm older, I'm already nearing the age of retirement, I don't want to take on so much risk. Can you imagine today, if I'm investing in this kind of big blue chip stocks giving me 4-5% dividend? If I'm not wrong right now, DBS is giving about 5+%. Or thereabout.
Yeah.
Right. So imagine if, let's say, at this point in time, I'm receiving 5+%. It sounds good, right? Yeah, but what happens if, let's say, touch wood, because of this tariff war, the entire market goes down, and then my dividends get half? Does that mean that my retirement income also half, right? Am I willing to tolerate this kind of circumstances? So if it's not, then maybe I would like to pare down my equities position and probably put more in bonds. And from there, that will give me a smoother volatility so that I don't have to panic. Last week, I can get to eat in restaurant buffet. Then this week, I need to eat teochew mueh. Nothing wrong with teochew mueh, but suddenly like the spectrum of the lifestyle is swinging up and down as well with the market.
Teochew mueh also a bit of buffet. It's just that you got a lot of selections.
Right? Teochew mueh also not cheap. With inflation nowadays, can be quite expensive.
Don't do
also.
all the fish.
But then the teochew fish is where the good things is at.
Sauté.
Correct.
But I think if I can summarize from another perspective is that whether things that are happening in the market 5 to 10 years down the line, it's very difficult to anticipate, right?
Yes.
It's very difficult to anticipate. What we can do is, I think there are certain principles that we keep to, like having a diversified portfolio based on your 100 minus age rule. And that will be something reliable in times of turmoil like this. Is that correct?
Yeah, more of like a guiding principle at the start, and along the way, as you get to know your risk profile, what's the kind of risk appetite that you have, then you can always adjust the allocation accordingly. Because most people are very fixated. Today Vincent says 70-30, I must be 70-30. Then each time always try to allocate accordingly.
Yes.
It's going to be a bit challenging, if you were to ask me. So it's best that, sometimes let nature take its course, understand your risk profile. If this is something suitable for you, then we invest accordingly. Yeah.
Okay, thanks for the insight. Every time we have these sort of things, right, there will be people who are very fresh in investing. I myself, although I have read quite a bit about investment, used to be a financial advisor, but I would still think I know I'm just the tip of the iceberg. And I think there are a lot of people out there that are like me. So perhaps if we were to give them something to start with, let's say today, some big guy who wants to invest in you gives you $100,000. What would you invest in? Vincent, how about you?
Well, that's a very good one. If let's say today I have 100,000, then as mentioned earlier with regards to the age, I'll take a look at what is my current situation. Do I even need to set aside a certain amount of money? In fact, last night as I was scrolling, I think Nas Daily had a similar experiment where he gave $1,000 to all his employees. Yeah, and then it was quite surprising that some of them just park it in the cash account, which of course we know that due to inflation is going to erode.
Yep.
A certain percentages actually tried to put in something risky like your crypto assets or things like that, and then it didn't exactly turn out well. Some of them tried trading. I think those in that group actually lost money, and there were some of them that actually had a diversified portfolio in terms of stocks, equities, index funds, or probably even funds and bonds. So that group actually did the best among all the other control groups that he had. So that was where it came to my mind that, at the end of the day, it's really very important, because if let's say, like what Cayden mentioned earlier, I don't have the knowledge. The worst is I thought I know, then I go and invest. Wow, this one is the most scary one. Yeah, then I learned the lesson the hard way. But if let's say today, if we think that we are just the average Joe, we try to diversify across the different asset classes. To me, that will be the easiest way. And then we can go back to the 100 minus H kind of rule as a guiding principle to start off. Then along the way, when we know our risk appetite, then we can adjust the allocation accordingly. Because the allocation is not cast in stone.
How about Cayden? Okay, Cayden, your long history of investing. What will you do with $100,000?
I can give one specific context. If I could travel back in time before I lost all my money when I talk about burst, if I could turn back time, if I could, right? The first thing I would recognize at that point of time is I really know nothing about investing. Yeah. But I have 100K of cash. So if I take this 100K of cash and then I buy something without any knowledge, it's actually equals to gambling.
Yeah.
Yeah. So most dangerous thing is not recognizing that we're gambling. Most of the dangerous thing is we are gambling, but we thought that we are investing. Yeah.
Really?
So again, if I could turn back time, I think a portion of this money need to go into learning how to invest. Yeah, but again, in my industry, it's a very complex industry because 90% of providers are usually in trading. So even if I could turn back time, right, I would still make the same mistake. And the reason why I lost money, partly because I got myself into option trading, stock trading, all this, in which I thought it was investing, but it was my fault. Yeah. So anyway, if I could turn back time, I think I was specifically focused on investing. And let's say if I spend 10K on education, then I'm left with 90K. So for the audience who are watching this, 10K, wow, 10K is so expensive. 10K expensive as compared to what? Some people have the money to buy condo, buy car, right? You mean you don't have 10K to set aside for education. But the interesting thing is those people who say 10K is expensive are people who lose 100K or more, right, in stocks. Yeah, so it's a penny wise, pound foolish. And then from that point onwards, assuming that I check off the knowledge, then I'll decide what to do with the 90. But let's say if I already know, how will my portfolio be like? I think the entire portfolio will consist of 3 components, right? The first component is cash. Yeah, because when the stock falls, you need to have cash to buy. So you always need to have something liquid. And that cash can be in T-bills, very short-term one. Or Singapore saving bonds where you can exit anytime with no penalty. Yeah, so short-term, highly liquid investments, so cash. And the other one, I'm long ETFs. S&P 500 is just one of the many. There are a lot of ETFs in the long term which will do well. And the last part, which is the most complex, right, is buying individual stocks. That would be how my portfolio look like if I could turn back time with 100K, 10K education, 90K to form the portfolio.
Yeah, then now he will be a billionaire already.
Yeah. Now I think about it, really, I wasted a lot of time and money.
But that's life, right?
That's
life,
correct.
is it?
Yeah. And there's one thing sometimes people don't know, right, is when you're 20 plus, when you lose 100K, you lose 100K. But when you're 80 years old, when you lose 100K, right, you also lose time. Because there's no way we can make the money back at 80 years old. Yeah, so time, in fact, is more precious than money. Yeah, so people need to recognize once you lose the money, it's very difficult. By the way, every 50% loss from the capital, for example, 100K, every 50% loss, you have to make that 100%, you know? Yeah, so it's easy to lose 50%, but it's very difficult to make 100%. So how can we say education is expensive? Cannot be.
The education, the knowledge, the skills really goes a very long way. The earlier we can acquire these skills, right? The more it can pay off. Yeah, because like you say, once the time goes, it doesn't come back. And the earlier you start, the earlier we can take advantage of that compound interest. Earlier you can take advantage of the rising markets, and especially in times like this, where although there are a lot of people, a lot of retail investors, a lot of businesses complaining about the red markets, but the savvy investors that I know I see on my Instagram, my Facebook pages, they are having a time of their life. Yeah. And also to add on another thing, the one you mentioned about cash, right? So this is a personal curiosity. So cash component is something that's highly liquid. Nowadays, there are a lot of high yield savings accounts from other major banks. For example, like DBS Multiplier, we have the UOB One as well as the OCBC 365. Right? Are these good alternatives to these T-bills or savings bonds?
In my perspective, I think as long as the capital is safe, then this would be an additional tool or instrument that one can consider to beef up their returns. Because as we know, putting your money in the bank, in the first place, it doesn't give you much interest, but the bank is actually leveraging on your money to make more money.
Yes, of course.
Yeah, correct. So that's why, in my opinion, if you can try to toggle and get back some of the money back from them, then that would be fantastic. But based on my understanding, I think the rates have come down significantly.
Oh yes, then, they just announced the drop, right?
Yes, correct. The first bank was OCBC that came out with the OCBC 365.
Yes.
They get very high interest.
it's a game changer.
Yeah. If you credit your salary, you have minimum spending of like what, 500 or 1,000. And then after that, you have some gyro or some other stuff. Then they'll help you to beef up your entire. But if you take a look at it, some of these things are actually not sustainable. So to me, right, at this point in time, I actually consider, should I be going after this as compared to, should I use the time to invest in other areas, like, for example, going for courses, learning from books and things like that? I think that to me actually makes more sense, because likewise, it's a little bit like penny wise, pound foolish. I can gain the extra maybe 1%, 2% from here. But if let's say today I get to know Cayden, and Cayden is my mentor, he tell me that today S&P is already giving you 10.4%.
Yes.
Why would I be so miserable about the additional 1 to 2%? I might as well put my time and effort on the additional 10%, or probably if I can find stocks that can give me better returns, or funds that can give me better returns, then the question is, why would I want to spend so much time on that? I mean, again, it comes back down to choices, no right or wrong. It's just that it's better use of my time, in my opinion, to grow a bigger pot of money than going for that 1 to 2%. So for me, I belong to the lazy category. I'm happy with the bank giving me the liquidity. My capital is always safe there. Yeah.
Right. At least for the cash component of your portfolio, 3%, is it a decent returns for the cash component of the portfolio?
Yeah, I think it's not too bad.
Not too bad. Anything to add?
For mine, I didn't put my money into those. But my circumstances are more different.
Of course, because as we climb up the ladder in the banks, you get access to other things as well. I get you, bro. My relationship manager never calls me, but I'm sure it's different from you.
So you can just tell, I'm a friend of Cayden.
Okay, so we talked about $100,000. And I think that also goes into very much where a newbie can start, right? You talked about putting money into education. This is like the analogy of sharpening the axe. So instead of going to work with a blunt tool, we sharpen the axe so that when the opportunity comes, we can take advantage of the time, take advantage of the opportunities, take advantage of these fallen markets to really grow. But that all starts with the education aspect. Right. But what else can a new person do beyond education?
I think it's still education.
Education.
Education. That one is still the pillars. There's no way around it. I mean, of course, that's one. And education comes in various forms. Books, YouTube. But again, like just now, I still remember you said that the sources are quite important. Right now, it's not whether is there a lack of information. It's which...
It's an overwhelming
It's which source of information is reliable. And like you go back to chocolate finance, you can see we just need two, if influencers say something, right, people will go and buy. So it's not the lack of information, but it's just too much. Which one can be trusted? Same thing, advisors, same thing.
How about this one? I've been thinking a lot because sometimes investing is such a huge monster to battle. One of the ways that a person can do is to dip their toes into it. Start small. Start small, or at least get started. How can I advise my younger self? You know what? This is the time to start right now.
Okay, maybe one way to help the audience change their paradigm, right, is they just need to Google, right, a Forbes richest list, richest people in the world, richest people in Singapore, and so on. You look at the highest one, number one, you go all the way down, right? Actually, the top 10, top 20 will be enough. So if you look at all these people, you just need to ask one question: what is common among all this? With no exception at all, right? Even if they go down the list, every single one is a business owner. Everyone. There's no exception. So if you draw a circle and then we say that the richest people are business owner, do they take up the minority of the population, or do they take up the majority of the population? So you realize that they take up the minority. So it's as good as saying 10% of the richest, right, make 90% of the money. So now the question is then who are the 90%? Wow, this one if I say, people will get pissed off.
Me.
So you see 10% are business owners. So the keyword is own. The 90% of group, they work for a business.
Yes.
So in this case, we are not saying whether which one is right or wrong. And the interesting thing is if you use muscle to make money, for example, your full-time job not enough, you go and drive a Grab. So the moment we work for a business or the moment we work for someone, we pay more tax. Because tax gets more when you use muscle.
Yes.
But if you look at the people who own businesses, right, they don't pay tax. Let me give you an example, right? Let's say you own Xchange. Let's say I just exaggerate. You own 10% of Xchange. Capital gain is non-taxable. Dividend is non-taxable.
In Singapore,
in
of
Singapore.
course.
US, of course, 30% withholding tax. So the moment they can see a paradigm shift from working for a business and owning a business, right, then then which one should they choose? Of course, they want to choose the top, right?
Yep.
So if they decide to move to the top and we go back to that whatever multiplier account. Now, when you pass money to the bank, right? Let's say the bank give you 3%.
Yep.
What if you shift your parent thinking to the top? What if you own the bank like Batman?
Wow.
Yeah, correct. Then that's different, right? Yeah. So how can a bank give us 3% and then they make 2% out of the 3% that they need to pay us? It doesn't make sense. They have to make more.
Yeah.
So if they make more, and you look at the CEO of DBS, the CEO who just retired, Gupta, right?
Yeah.
Whose salary is 15 million, right?
Yes.
I'm quite sure DBS makes a lot of money.
Yeah.
So why don't you be on the business side? You own the business rather than
Right.
passing the money to the business.
Right.
Yeah, then of course goes back the question then how do you own the business? Then you go all the way back financial education. Yeah.
Totally
True.
agree. Yeah.
How about Vincent? Are there other things you would advise to people who are just starting out? Fresh meat.
Talk to me. Yeah, exactly. WhatsApp me at 1, 2, 3, 4, 5, 6, 7, 8. Or go to this link.
Yeah.
Yeah,
You go
talk
to
to
this link
Vincent.
at the
He will
below.
start drawing for you the triangle.
You never take out a banner, man, with the WhatsApp number.
This one you can add in post. You put it on the screen.
No need print out, yeah.
Yeah, now these are digital. Yeah.
Yeah, you just
Check
you
out
just
the bio
add in
link.
post.
I need a
link in
link
bio.
below this video.
Yeah. Okay. I think of similar thoughts like Cayden, but I would say nowadays the people that I'm facing are actually getting more and more savvy. In fact, when I actually share with them some of the financial products or things like that, they will actually ask me, "Hey Vincent, I've come across certain websites or things talking about this and that." They sort of like give me a different perspective of what you had just did. So maybe can you help me to reconcile what exactly are the differences? So I think that's the part whereby, like what Cayden mentioned, there's no lack of information right now. And in fact, even after I share my proposal, most of the time the clients or prospects or friends, they also go back and do their own due diligence one. Yeah. So that part to me, I'm really very grateful because at least before they buy into a certain product, they are doing their due diligence. So they're going in with the eyes wide open, so to
Right.
speak. So that part there is where, to me, doing your homework, getting the due diligence is very, very important. And the next part is actually understanding yourself when it comes down to investing. That to me really is the more critical, more important part, because you can have the information all up here, but if it does not translate to here, it's very difficult for you to process. So going back to the earlier example whereby, like what you mentioned earlier, Jackie, you scroll through your Facebook, you see most of your friends telling you that, now it's a great buying opportunity. I saw Cayden was also smiling from year to year. He also agreed.
Actually, I want to crack a joke, but I think I better control myself.
Oh, we can cut it out in post. We can cut it in
The
post.
zero. Yeah. So that's where I realized, sometimes it can have all the information, but if you do not take action and you do not try it out and get to know yourself more, it's going to be very challenging. I can bring the cow to the river, but if the cow doesn't want to drink, it's going to be very difficult. Or if the cow thinks that the water is toxic, it's even worse. Yeah. So that's the part whereby it becomes very important to know, today, if I'm going to invest, what is my kind of timeline? Where do I want to go? And do I have the kind of risk appetite? Because the worst is, if let's say I get the inputs from you, I don't even know if it's true or not, especially if we're on the first phase of the relationship, right? So it's where we get to know each other. So that's the part whereby, for my role, is actually to identify whether this thing is really suitable for you based on our conversation, understanding of your situation, what are your needs. So people always think, financial advisor always do fact find. This one is always for the compliance purpose one. Yes, part of it is really for the compliance purpose. But the second part of it is for the sustainability of the individual investor. That is really important because we do not want to be caught in a situation we think that we are aggressive. Then after that, we are not, that kind of loss, who is going to bear? Yeah. Then it's always very easy to say, that particular advisor, Vincent, didn't do a good job. Then it's very easy to point fingers.
It is. Yeah.
So that's the part whereby it becomes important that we know what we want, where we are going, what's our risk appetite. That makes it easier. Then with like what Cayden shared earlier on the knowledge, going for courses or going for his courses as well, then that's the part whereby it helps us to give us the confidence. Because to me, knowledge is helping you to gain confidence. It's like driving. Today I can have a driving license. But if you don't ask me, do I dare to drive a truck? That's a different story. Do I dare to drive like a F1 racer? I also don't dare. Yeah. So even if I have a driving license, driving different vehicles also makes a lot of difference. So that's the part whereby it becomes very important to know where are your capabilities. If you're going to outsource, of course, by all means, but maybe you also will have a general idea. Another analogy that just came to mind is like engaging an ID. ID will always ask you, right, what's your design idea? Yeah, what do you have, your preferred style and things like that. Likewise, we are like the ID of your portfolio. Yeah. So if you do not know, very difficult for us to propose also.
One of the things that newbies will definitely do, and also I sincerely believe advisable do is to look for a trusted advisor. Now, what are some qualities you would advise someone to look out for in looking for? Because you talk to everyone, you ask them, they will for sure at least know 5 other financial advisors. Yeah. Who to trust?
First things first is when you are speaking to the advisor, I think most of us will get a general vibe whether this advisor is really going for the sale and pushing the sale, or is this advisor really thinking for me. So to me, it's very difficult for me to give you a framework like, oh, these are the 5 things that you should look out for. It's more of like a vibe, a feeling. So sometimes it could be a case whereby it may not be a good match. May not be because the advisor incompetent or the client is not ready kind of stuff. Probably the client is very ready, advisor also competent, but probably it's a very different frequency. So to me, in the advisory field, it's very much like singing. We all have different singers or talents that we adore or probably listen to, different styles and things like that. So it's very difficult for me, like let's say I like Jay Chou, then another audience say Jay Chou is, in Chinese, they call 咬字不清. That means you can't articulate clearly.
It doesn't open his mouth when he talks.
Exactly. So that's the part whereby this is my personal preference. Doesn't mean that I'm wrong or anything, but I think that this one vibes well with me. So therefore, that's the case. I'm willing to work with this advisor. And then we can test it out from there, see if it works for this particular relationship. It's like the choices that you make at the end of the day. So very difficult for me to give you like 1, 2, 3, 4, 5, what are the 5 things to look out for, but more of a feeling.
Chemistry with the person.
Yes, chemistry. Yes,
because
that's right.
at the end of the day, it's going to be a working relationship.
Yes.
And if things turn sour and then you have money placed with him, that's also not going to be a nice feeling. Right?
Correct. That's right.
Yeah. But beyond looking for advisors, something that has been a very major theme when we in our conversation here today is really equipping ourselves with the proper skills, proper education.
Yes.
So, and of course, from the introduction and also from the sharing earlier, Cayden, you run various events, webinars. Could you tell us a bit more about that? So people who are interested or looking to get started, where they can begin looking out?
There are 2 sources where they can get information, right? First thing is they can always go to my TikTok channel. TikTok channel, all lowercase, right?
Yeah.
Cayden Chang Investing.
I'm going to put it right here.
So Cayden Chang Investing. Now, this is very important because I have at least maybe 20 imposters.
Oh, yes.
Yeah, TikTok account a lot. So it's Cayden Chang Investing lowercase. Very important.
I think I got added into some imposter of Cayden Chang.
They can Cayden Chang Investing, right? Instead of a small eye, they can have a big eye. So other than this, the rest are all fake.
Right. Only one.
One and only.
Or can do business with only one account.
Only one, but got many clones. So that's one. But of course, that one is just passive, like you watch and so on. If they want to see me in person or talk to me, right, they can always attend one of my free value investing masterclass at www.viamasterclass.com.
VIAmasterclass.com.
One single word.
Okay. VIA, Value Investing Academy.
But short for
VIAmasterclass.com. We're going to put it on the screen now, of course.
Yeah, screen.
I don't know which one.
All the links.
VIAmasterclass.com. I think these are the 2 starting points.
All right.
So I think before they do all this, I think better don't buy any stocks.
Better don't buy any.
Yeah.
So after they go for it, then okay.
Then it's a matter of choice. Matter of choice. Same thing. I think even for advisors, there's no obligation. You need to have the feel of the vibes.
Exactly.
Really. Yeah. This one I understand very well. I've rejected so many advisors. I feel like, it gives me a sense of power. No, but it is something. I'm sure, Vincent, you're used to rejection, right? With a face, I'm just kidding.
Back in my earlier days, I used to do door knock, street prospecting. So you can say that getting used to rejection is part and parcel of this career.
Indeed.
Yeah.
So I believe people who are looking for something that's more tailored or someone to sit down with them to walk them through the basics of investing or even like hold their hand through the investing journey. This is what an advisor does, right?
Yep.
So what can they expect in a relationship with you?
Yeah.
Investing relationship, we got to make that clear. I'm married, right?
No,
not married. Okay, so
married.
open game, guys.
There's WhatsApp number.
WhatsApp number.
Then I'm going to get spammed.
One WhatsApp for business, one WhatsApp for
personal.
Q&A JB.
Yeah. Okay. So jokes aside, I'll say for start, as I mentioned earlier, is probably get to know the individuals better in terms of the circumstances, what are they looking for and such. Then we see if it's a good match and probably even a good start. Because at the end of the day, like I shared earlier with regards to my friend having to buy a property at the point in time. So maybe we are of the same frequency and we had the chemistry, we can work together. But maybe at that point in time, it's not exactly the best time to start investing. Probably there are other areas that we can look at, because at the end of the day, I also do insurance because I'm a financial advisor at the end of the day. So we can also do insurance or probably other categories of areas that you may have blind spot or you may not be aware of. For example, I've come across clients, right, whereby they really want to start investing, but at this point in time, they haven't even built up their emergency cash. I really don't dare to do their business. Not that I do want. I told them, frankly, why not you put aside and get to know what are your expenses in the first place? Because she told me, hey Vincent, honestly, when I get my income, at the end of the month, I don't feel like I'm saving much. My bank savings have always been stagnant for the past 3 to 6 months.
Right.
Yeah, and this person is not young. She's, if I recall correctly, past 30 already.
Oh.
Yeah, so that to
You're
me...
saying I'm older.
You are younger.
Hey.
Yeah. So given that situation, I was a little worried, and then I told her, why don't we take a look at what are your expenses first, and then from there we decide how to take it from there. So that's the part whereby I find that it's very important to even start investing, right? To get to know how your money is flowing in your own pocket.
Right.
Because if you do not know your own cash flow, it's very difficult for me to plan ahead, because when we're investing, we're talking about timelines of years, not months. Yeah. It's very difficult for me to do trading for you. Yeah. If I'm really that good, probably I don't even need this podcast here. I'll be sitting at home doing trading. But the key thing is, I find that this is not very sensible thing if, let's say, I would just to do the business and then ignore it just because the clients wants it. But really what's best for the client. So given this situation, I told her we can come back and review. And true enough, after she have managed the, expenses, she roughly know, then that's where we set aside a small amount to test water first. Yeah. So I think for a start, especially if you are investing for the first time, I don't dare get the full amount that you are giving me. Yeah. So I usually will take a portion of it. Once you're comfortable already, we can always up the amount. Because unlike some of the other providers out there whereby they need to have a fixed lock-in, for 5 years, 10 years, this amount you can't vary. If you vary or you stop the plan, and then as a result, there'll be penalty. So I usually don't go with that first. I go with something that is more flexible, for example. So once they have the flexibility, they know that they can stop or encash at any point in time, they feel more secure. Once they're ready, we can move over to the pot whereby it's locked in. Yeah. Right. So that makes it easier.
So there's a kind of a trial period.
Correct. Yeah, probation.
Probation, hey, wow.
See if I'm the right person for the individual.
I think that's a good thing because, like we said, it is a long-term relationship.
Yeah.
So, but of course, I believe for any of our viewers out there, we are talking about two types of advice, or things that we can get started on. Like, of course, this is not... I mean, you want to say promote is promote, but at the end of the day, these are channels without obligations, right? Yes. You can can attend any one of your Cayden's event. Once again, that is www.viamasterclass.com. And I'll look at for Vincent, number. You'll be posted on your account.
Oh, yeah. I'll post my number.
Just drop him a DM.
Yes.
And he's single.
He's single. Available.
Available.
Okay, how many?
But after this podcast, I'm not so sure.
Hey. Wow. You're really hedging your bets. Yes. Yeah, but of course, these two channels, now we go into something that is quick. It's okay, so one topic and then you can tell us true or false and what are your thoughts on it, okay? So perhaps we start with, this I want to go with Cayden. Okay, investing is just like gambling. True or false?
It's both true and false. If it's true, provided the person know nothing, then it's true. If it's false, then the person know a lot. Yeah, so it's both true and false.
I start contrast from what I actually hear a lot because they say, trading is gambling. Investment, no. But investing without knowledge, there's no difference.
Yes. Correct.
Okay. High returns are only achievable with high risk investments. I feel like we've touched on this topic earlier, but Vincent, can you tell us true or false?
I would say it really depends on the individual, like what Cayden mentioned earlier. So it's akin to the analogy of driving that I mentioned earlier, that if let's say today I probably only have a class 3 license, I can drive a normal sedan or hatchback. But if you don't ask me to drive probably a lorry, a truck, or probably even like those kind of F1 cars, I don't think I'm capable of doing that. So in that scenario, your vehicles are like your different instruments. You may have the knowledge for this particular instrument, but you may not have the knowledge for other vehicles. So it becomes very important to understand that, today, if let's say you have the license to drive this, I would say you are capable and you can control your volatility or your fluctuations. So it's very much like you have the expertise to do it. But if let's say today, like what Cayden mentioned earlier, wow, today I don't know anything, or I thought I know, then as a result, maybe my this license is fake one. Go and buy. Then I go and drive. Then obviously I'm asking for trouble.
Kopi license.
Yeah, kopi license. then I'm obviously asking for trouble. So given that situation, it becomes very important to know where are your circle of competence.
Yeah.
I think this is from was it Buffett? Yeah. Circle of competence, whereby you need to know these are your areas where you are more comfortable investing in. And the good thing is your circle of competence can always expand. It need not be always restricted in that. Yeah. Right. So that's why it becomes important, like going for classes with Cayden, getting to know more, be Cayden's good friend, make sure that you're going to the right TikTok channel.
Oh, bro, you really...
No, but this one is really because I get to work with Cayden as well. Then I realized that it is very rare in today's context to have someone that actually gives value. Yeah. And asking nothing in return. I think that's really the amazing part about Cayden. Yeah. So that part there is where I enjoy working with him and learning from him.
Right.
Yeah.
Okay, I do want to bring up something because this is something that I've related to. When I was younger, I actually followed my dad to some of the investment workshops that he attended. And one of it was options. Options is because you're talking about competency.
Yeah.
And sometimes there are these instruments that are just so many buttons and levers.
Correct.
Like options.
Yep.
And then that's why they have so many different strategies or the eagle, what spread, all this. And then I look at it as all a Greek, man. But then at the end of the day, people are just like following the instructor. Okay, you do this. But when you ask them what they are doing is, actually I don't know. I just follow the instructions.
That one I'm very familiar.
Yeah.
Yeah.
So that is very complex. You've been through that before.
I've been through that. I know the industry very well.
Oh,
yeah.
Goodness, yeah. But it's a lot. It's also something that very attracts people very easily.
Yes.
But I think the bottom line is you have to know what we're doing. If not, we are getting ourselves in hot water.
Correct. And take responsibility for it. That's the important part.
Investing is too complicated. I need to be an expert.
It is complicated for anyone who knows nothing, of course. It's not complicated for those people who know a lot. Yeah. So there's always a journey from know nothing, right, to know something and then know a lot.
All right.
Yeah. So the person has to take the first step. Yeah. Nobody can force them. So like what I say, you have to learn both the qualitative part and the quantitative part. Once you understand, you move to the world of business owners. It's actually not that complicated.
Sometimes I talk to business owners. Some of the more savvy ones, when they look at a business out there, one look they are able to guess, okay, this business can make it, this business cannot make it.
Yeah.
Especially for the bigger ones, they start to invest in other businesses. They have very sharp eyes, or rather they know how to see beyond the veil.
I would say sort of like a financial lens. When I didn't know much about investing, like back in the earlier days, I always focus my perspective and my focus on the prices. Then I realized that it doesn't quite work well for me. Probably there are other methods. And that's where I realized that, value investing or long-term investing actually works better for me. So that's where when I go out to the street, I realized that, I'm starting to see things with different lenses. What do I mean by that? So say, for example, recently I went back to China to try to get some new leads from China side. So imagine walking to a mall, high-end premium malls. You think that by right should not be affected by right because they are rich people. They should be able, regardless of whatever nonsense or wars out there, they should have the buying power. But surprisingly, that mall itself, it was peak hour during dinner time, probably about 6-ish, 7-ish. The mall was empty. Only a handful of people. The restaurants that we were at, there were only 2 tables, and we were one of the table that was there. And that table. Apparently, what I learned from my Shanghainese friend is that they are having a bulk discount on their Pinduoduo app or the 大众点评. They call it 大众点评. Yeah, the kind of group discount app. So that was where I realized that, wow, the economy, even on the other side, whereby you're talking about a major powerhouse, is also suffering from this kind of turmoil. So that to me brought home the point whereby, today, if I were to invest in, say, in this particular example, China, these are on the ground experiences that I get to see and translate to me as an investor that maybe now is not exactly the best time to invest in this particular geographic area. But of course, there will always be different perspectives. Some others can say that right now is the low, therefore you can always buy and then wait till the economy recovers. So I'm not going to go down the rabbit hole of saying what's right or wrong or whether we should or should not be investing. But what I mean is more of like a lifestyle already, like investing. You put on different lens today, you're putting on the lens of an investor today. Wow, this particular company is actually doing well. Is it even listed? So these are some of the questions that along the way, as I start to progress, it becomes like your subconscious mind. Yeah, then you start to enjoy this entire process and wow, actually investing can be quite fun. Yeah, correct.
So actually, it's not that complicated. My background is in biology.
Oh, biology, bro.
That's quite a big jump.
So you mean that's your NUS degree?
Yeah, I got 2 degrees in biology, and then to move from one space to another space, I think it's all about the willingness to learn. That's about
Indeed,
it.
indeed.
Yeah, there's no such thing as there is a knowledge, but it's not learnable.
Yes.
Well,
I mean, there's no such thing.
I think that's also a very big theme in Singapore right now. Mid-career switch, skills future learning. Let's go.
Lucky our degree are not going to expire in 5 years.
Yeah. But at least, I can relate because I myself, I got my degree in NUS physics. And the thing that I'm in events, I'm a MC right now. Nothing to do with my degree at all. Previously in financial advisory, also nothing to do with my degree. Eventually, we all kind of find our paths or we fall into our paths. And all the things that happen to us along the way kind of bring us here. And I think so far, I'm sure you're pretty successful.
Okay.
There's enough to eat, enough to...
Still a CDC voucher.
Yeah, still a CDC voucher. Okay, good.
No complaint.
Anything else? Any final thoughts you want to share with our friends? Vincent, how about?
Yeah.
At the end of the day is there are really many choices out there in the market. So do your due diligence, find out more about the respective sources before you even embark on this investment journey. Yeah, and then if you have been investing for a while, you realize that, I'm sort of like hitting a brick wall, not exactly sure what's my blind spots and things like that. Can reach out to any of us here.
Yeah, don't reach out to me. I know nothing.
I want to get to know Jackie. Is Jackie single or available?
Yeah. Right, how about Cayden?
I think for the past 5 years, the biggest realization was choice is more important than pure hard work. Because I was brought up in the era where my parents would say hard work.
Yes.
Yeah, I mean, if hard work can make anyone very wealthy, then people who, like for example, the foreign workers cleaning HDB, the coffee shop, taking care of whatever, removing the utensils, they'll be very wealthy. But why not? They're hardworking, right? Yeah. So I think choice is very important.
For sure.
Yeah. So, but the hard work forms the basic foundation.
Yes.
Yeah. Without this, nothing else works. Then on top is to make the right choice. And to make the right choice, it has to hinge on the knowledge. Yeah, because the choices that we make is limited by what we know and what we don't know. Yeah. So hopefully the audience, after watching this podcast, will have a better choice.
I can put it in an analogy of investing as well, right? How it being capital.
Yeah.
And then your choices being what instruments you use
correct.
and how you invest.
Like 1%, 10% makes a lot of difference.
So you can have a huge capital, you put it in something that doesn't move at all. Yeah, you're not going to go anywhere. Or in fact, if you put all your hard work into something that is detrimental, end of the day you lose your health. You don't have that much money. Yeah.
True.
But at the end of the day, with knowledge, with the proper knowledge, right, we can choose where to put our hard work into. And then that might have multiplying exponential effects. Yeah. So with this, thank you very much for the time. I hope you have enjoyed the conversations here. And also for our viewers, I hope that you have enjoyed this conversation. After all, at the end of the day, it is a sharing. It is a sharing about investing. We all have our own stories in life, the kind of experiences that we have. Some of us have lost money. Some of us are just starting out. Some of us maybe we're doing very well. Just want a different perspective. But hopefully this has been something that has been able to add on to your experiences or knowledge. And because if you want to find out more, I think Cayden as well as Vincent, they are very happy to share whatever they can and whatever they do have with you. So with this, thank you very much. Once again, this is the Affinity Exchange. Hopefully we'll see you next time.
Thank you. Bye.